a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Will European ETFs outperform in 2017? We're going to find out from our ETF research director, Nina Mishra, who joins me now. So these European stocks have been doing well so far this year.
Yeah. That is thanks mainly to better than expected economic as well as earnings growth. Economy has been gaining momentum and earnings have also been growing. In fact, in 2016, Eurozone's economy grew faster than the US.
Wow.
For the first time since 2008. And it's not just the area's economy, Europe's economy, which has been growing. The global economic growth picture in general has been brightening, which bodes well for European companies because European companies, they have a lot of overseas revenue exposure. They derive almost 50% of their earnings from abroad compared to 40% for S&P 500 companies. So the pickup in economic growth in developing as well as emerging markets, that is good for European companies. And then earnings stagnation ended during the in the fourth quarter. For the first time in 4 years, earnings growth picked up.
Sure.
And earnings growth expectations have also been rising with a rebound in commodity prices and rise in interest rate expectations, which is good for financial companies.
And a little bit of political risk thrown in for good measure too.
Yes. Yeah, the zone is not without political risk with the upcoming elections in Germany, France, the Netherlands, and possibly in Italy as well. Now, it's possible that the political risks have already been priced in because here also people talked about what is going to happen if Trump gets elected and the stock market is doing so well. People worried about Brexit too, and nothing happened. So political risks maybe have already been priced and the elections are known. And in addition to economic and earnings growth, another reason to look at these European stocks is that they are much more attractively valued compared to US stocks, because US stocks have been rising for the past 8 years and many investors are now getting worried about stretched valuations. So European stocks look much more attractive in terms of valuation, and international diversification is always good for portfolios. It makes sense to add some international exposure, some exposure to European stocks and some exposure to Japanese stocks, and some exposure to emerging markets in a portfolio.
So it's always in a nice picture in the rear view mirror. But what about looking forward? Do you expect this trend to continue?
I expect the trend to continue because economic growth has been picking up, earnings are rebounding, and as I mentioned, I feel that political risk may have been priced in to a large extent. But I would like to add that if you're thinking of getting exposure to European stocks, be aware that the euro may continue to depreciate against the dollar because of the monetary policy divergence, because the Fed has started raising interest rates here, and they have penciled in 3 interest rate hikes for this year.
Yes.
So maybe 2, we'll see.
Okay.
But the ECB is still in the easing mode. So if, in that case, the dollar may continue to strengthen. So that is why the 2 ETFs that we are discussing today, they are currency hedged Europe ETFs. So
I see.
they provide exposure to Eurozone stocks while hedging out the currency risk.
All right, let's take a look at this first one, which is the WisdomTree Europe Hedged ETF, Equity ETF, right? HEDJ, the
yes,
ticker.
so it is the most popular currency hedged Europe ETF, has more than 9 billion in assets under management. It focuses on exporters within the Eurozone, exporters, dividend paying exporters. So if the euro weakens, then these exporters benefit.
I see.
So if you believe that the dollar is going to appreciate against the euro, then these companies will benefit, and this ETF is worth a look. Charges 58 basis points in expenses and has a nice dividend yield of 2.75%.
And that always helps. The next one is the iShares currency hedged MSCI Eurozone ETF.
The ticker is HEZU. This has exposure to exporters as well as domestically focused companies focused on the Eurozone. It has smaller assets under management, 1.2 billion, slightly cheaper with the 51 basis points in expenses, and dividend yield is slightly higher at 3.1%.
So let's see how these two stack up against the S&P 500.
So I have put the performance chart over the past 3 months for the two currency hedged Europe ETFs, most popular currency hedged Europe ETFs, and compared that with the broad market US ETF represented by SPY. So as you can see that HEDJ, the one who focuses on exporters, was the best performer with more than 11% return over the past 3 months. The other one had about 10% compared to about 8% return for the S&P 500 during the same period.
Okay. Well, do you own either of those two?
No, I don't.
All right. Thank you for that. And don't forget, you can check out more ETF information on our website, Zacks.com. So if you're not there already watching this video, get over to the home page, use the Funds tab in the top toolbar. That'll help take you to the ETF section of our website. With Nina, I'm Terry Ruffalo.